dash. All right. Okay, basically, if maybe I can try maybe to explain to you the difference between like ordinary shares and preference shares, I would say like okay, ordinary shares basically are the are shares for the owners of the business, while preference shares are shares that belongs maybe I can say maybe to the general public, those individuals who are not like the co-owners of the business, but who has like direct interest in that business in terms of maybe trying maybe to grow their money one way or the other. So basically, this is what happened in an organization. At the end of the year, you find like the company will then distribute dividends. And then what happened? Preference shareholders, as the name, as their name, you find that they will get their dividend first before the ordinary shareholders can get theirs. Yeah, I think that's it. And then when it comes to okay, this topic like of share evaluation, basically, it's okay. I think maybe you find like there is this theory that is being used when on the cost of capital topic. Yo, let me open my video. Seeming I can't talk when the video is off. I got a serious note. On a serious note. Yeah. Okay, I'm sure that you are aware about these two models that are being used. That most of the examinations that you write, you find them there, which is like the Gordon model, and then CAPAM, and then like I think you need like to familiarize yourself with those formulas that are being used there. So I just want us maybe if we can jump straight to that. Uh, to that. Okay, do you have any example that we can try maybe to crack that has to do with cost of capital? I just want maybe to give you some hints there and there. We won't like it go maybe through everything there, just because I think you do have like plenty, or you do have plenty of examples on your end.
No, I don't have a specific paper. I was still just doing the theory part. But I was hoping that we could go through, the previous example that we've done already.
For that example, okay, maybe let me try
Yeah.
to browse it on my machine.
Okay.
Let me try to browse it. But Zoom cannot minimize. Answer there. Okay, let me just browse. Zoom. Language. You?
Milton?
Okay, I'm trying to open some. Like I've got plenty and plenty of these recordings here. So. Yeah, but I think I don't have like the question paper with me.
See if I can check that out.
Can you try maybe to check on your archives? The question
Yeah.
paper that you were trying maybe to solve. Okay, I think this one. Was it the one that you were by like the one that you guys? I think this one is the one for your assignment. I'm not sure.
I think it was not the one on the assignment. That first one.
Okay, let me just check any question. Am I going to find a soft copy? Oh. And you don't have like the resources. How are you going to write your exam?
Hey,
Yeah,
was it?
I'm saying you don't have the resources with you. How are you going to write your exam?
Which resources, Mus?
Okay, can you please like share with me maybe your assignment, like the question paper of your assignment?
Yeah, I'll share that, Nana.
Yeah, just because. Okay, I just want to give you some hint there and there. When it comes to this thing of like investment appraisal, you okay?
Investment appraisal. Yeah.
You good?
Yeah, I think I'm okay there because we're basically looking at payback period, the average accounting rate of return, net present value. Yeah, I think I'm good. Let me just share that with you.
Are you going to share that? Is it gonna be via WhatsApp or you gonna share?
Yeah, I'll send it through WhatsApp. Sent. Yeah, sent. Yeah, it's on?
Yes, I'm opening. But to be honest, no, Kanya, there is really nothing much complicated.
Yeah, I'm figuring that out. See, I think for me, maybe it was the panic more than anything. But as I go through the stuff, like investment appraisal, I think I've gone through that kahle, and I think I'm comfortable.
Uke wacheka lama videos lebe siwakhulumisa kuqala.
I haven't finished all of them.
Yeah,
Because
I think you must give yourself time to go through those videos just because I think we're trying by all possible means maybe to explain everything there.
Yeah.
Yes, about Saturday. Yeah, I think maybe I'll try by all possible means to be available when you write your exam. Yeah, but you must study like literally study. But what you have sent me is the modular guide. It's not the question. Like I want you to send me like the soft copy of your assignment. I want to guide you with one or two things there. This is the modular guide.
Okay. Okay.
Calendar. Yeah. There we go. Bantu bang umsindo on your background.
Shalom.
Eh?
Shalom, busy.
Awumtshengani ukuthi useklasini mina.
Oh, are you asking me to invite her over so that she can make me?
No, I'm kidding. I'm kidding. Okay. And okay. Question 4.
Yeah, I think it's question 4.
Question 4. Question 4. Maybe let me share my screen. Can you see my screen?
Yeah, bro.
Yes. Okay. Yeah. Okay. Yeah. Okay. Basically, here, I hope that you are aware that when you're doing like your weighted average cost of capital, you have to go through 3 steps. The first step, you will be calculating like the market values of those forms of capitals that are there. It can be like ordinary shares, it can be preference shares, it can be bank loan, it can be debentures. Yes. And then the second step, you need like to calculate the cost of capital for each form of capital, let it be like bank loan, debentures, preference shares, ordinary shares. Yes. And then maybe another thing that maybe you need like to know so that you wouldn't mess up on that day. The fact that okay, when it comes to these models, which is like CAPAM and Gordon model or dividend growth model, affect only ordinary shares. Are you following?
Yeah, can you just say that again?
Dividend growth model, also known as Gordon model, and CAPAM only applies to ordinary shares, not preference shares, not bank loan, not debentures. That's the first hint that you have in mind. And then now let's say maybe we want now maybe to calculate like the market values. The market values, maybe let me just share another screen. Let me stop sharing this one. I want to share another screen with you. Which one? Which one? Not this one. Oh, I think, yeah, it's this one. Can you see my screen over there?
Yeah.
Yes. Okay. Basically, if maybe I can go back to the question paper, it's read as follows. Okay, I'll start start with their present capital structure is as follows. 1.2 million, two rand ordinary shares now trading at 220 per share. Yes. Another hint or a tip that you need to notice here. You see, these shares were issued at 2 rand each. The value of a share were on issue, it was like 2 rand. And then now they are trading at 220. Have in mind that you are calculating market values of the shares. So when we calculate market values of the shares, we need like to use the current price of a share, which in this case it will be 220 instead of 2 rand. That's 2 rand is the value of the share when it was issued. Are you following?
Yeah.
Yes, even on preference shares, they are saying like 80,000 preference shares trading at 180 per share, issued at 2 rand per share, interest 10% per annum. What you need to focus on when you calculate like market values, you need like to focus on trading at like the current price of a share. This price, you see, like on preference shares, it was the value of a share was 2 rand when it was issued, but now it has dropped to 180. So in this case, you will say 180 times 1.80, and then you will get like the market value of the share. So same thing on a bank loan, but on a bank loan, you do absolutely nothing just because the value will remain like that. It won't change just because that's money. Okay, the reason why maybe we multiply, okay, one thing that you should have like in mind, you see that 80,000, that's not money. It's the number of shares that are in that particular company, number of preference shares in that particular company. So, and then trading edge, that's when we talk about money. That's the reason why you need like to multiply that 80,000 with that 120, with that 180. And then that 1.2 million with that 220 to get like the market value of the shares. Yes. Let me, yes. I hope you can see my cursor over there. Yeah, perfect. Okay,
Yeah, I can see
that's
it.
the exact paper that you are. Yeah, this is the assignment. You see what we did here?
Yeah.
We multiply this by 220. We get this market value. Preference shares, we multiply 80,000 by 1. We get this Val Bank loan. We just put that 1 million as it is. And then what you need to do, you need then to sum up this total capital. You just need to sum up all this market value. And then after that, you need like to get this weight. This is just simple mathematics. There is really nothing complicated here. Just because what you do to get this weight, you will say like 2,640,000, 2,640,000 divide by total capital, which will give you that 0.6977. 144,000 divide by 3,784,000. You will get that. And then this weight should sum up to 1. It's more like you are trying maybe to simplify this. It's more like you are putting these in ratios. Yeah. It's just simple like that. And then you see, like there is this okay, this is the formula that you use to get the weight. It's capital market value over total capital. And then you are good to go. And then after that, you need like to calculate like the cost of capital for each form of capital that you are having. So in this case, uh, yeah, you should have in mind that these two models, which is like CAPAM, capital asset, this CAPAM and the current model only affect ordinary shares. What? Okay, during the examination, you find that they will give you maybe this formula, but it's always best maybe to know this formula by head so that you wouldn't maybe waste time during the examination. Just because you find that maybe there will be some difficult questions that maybe will need you maybe to think a bit. So you need when it comes to this thing like of cost of capital, you shouldn't maybe the marks are like maybe 25. I think scope 20 at least. Why not 25? Yeah, but okay. When it comes to this thing, like when you use like CAPAM, that's the formula over there. I hope you still remember it. Risk-free rate, this is beta. Return on market, risk-free rate. Okay, maybe let me just stop sharing this screen. I want maybe to show you on how do you go about maybe identifying this in a question. Let me share another screen so that just because right now I'm not teaching you anything, I'm just giving you some hints. Can you see my screen?
Yeah.
Yes. Yeah, maybe during your examination you shouldn't maybe be confused. You see, point A, point okay, additional data. This whole thing applies only when you are like you are using CAPAM. Beta, you find it like this. Return on market like this. This is the RM, risk-free rate, 7% applicable. Okay, yes. And then what else are you going to use? Okay, when maybe you use like a dividend growth model, this applies on the dividend growth model. Point number C applies on the dividend growth model just because, yeah. And then like I will show you all these things. Okay. Right now, what else? Maybe let me
On
go
the
through.
paper, will they always specify which use Kappa model, use Gordon model?
Yes, they will
Always
specify.
specify that. Okay.
Or they will, okay, they will, at some point in time, they will ask you to use both models to calculate the cost of capital.
So you would have to.
You have to know both models.
Oh, okay.
Yeah. Okay, CAPAM is simple as compared to Gordon model, just because in Gordon model, there is quite a number of calculations that you need to do. In CAPAM, you just need maybe to master like the formula and then substitute. And then one more thing that you should have maybe in mind is the fact that you you need like maybe to decide whether to use the percentage as they are like 12%, 7%, as they are, or change these to decimal. Yeah, so you need like to master that as well. During like maybe confuse the two, and then some mistakes that are being done maybe by other students, you find that they will change 12% to decimal and then go on and use like that 7% as a percentage. So that's a big mistake.
Mm.
If you decide maybe to go with decimals, you change everything to decimals, and then at the end of the
Yeah.
day, before like you can say like you are having like your final answer, you need like it to convert that to percentage. You need like to multiply your answer with 100 so that you
Back.
can have
Okay.
that in percentage. But when like you
Mm.
using this kappa model, it's best maybe just to use the percentage as they are. If maybe
Okay.
okay, let me just stop sharing this screen and then we go back maybe to our solution paper. Let me share our solution paper here. Yes, as you can see over there, we've used like that risk-free as 7.7% beta, so on and so forth. Okay, and then
Mm.
one more thing, I think maybe you are familiar with you are an IT student. You must be familiar with mathematics. You use what you call Bodemas rule.
Yeah.
Is what you need to do. You start with some things that are in the bracket. For instance, here you will say like 12 minus 7, you get 5. And then that's when you will multiply that 5 with that 1.4. And then after it, you can then add. You get your answer.
Yeah.
Simple like that. You have your marks. And then when it comes to preference shares, the formula is just simple like that. It's D over PO, P0, if I can put it in that way. Yes, okay. Uh, Basically, okay, let's go back maybe to the question paper so that we can relate to what is happening there. Okay, maybe let me stop sharing this. So right now we are dealing like with preference shares. You see, there is that interest per annum over there, which is 10%. You see, that's another element that maybe that can guide you a bit when you want maybe to understand like preference shareholding, my preference shares. You see, just because when like maybe you go to Stanley maybe to do your investment, there is a certain percentage that act as your interest on your investment. If, for instance, you've invested 100,000, which means after a year, if the interest is 10%, you'll get just 10,000 rand on your investment. So they try like, yeah, I hope like that makes sense.
Yeah.
Yes. So if you, okay, what you D in this case, you will multiply the interest by the okay, like the share price in issue, which in this case you will say 2 multiplied by 10%, and then you have to divide that p0, it's that 1.8 over there, or 1.80 over there.
Okay.
Yes, yeah. There is no need of maybe of knowing this thing in depth. It's just a matter of like to cram this thing. How do you go about
And
doing that?
practicing it.
Yes. How do you go
Hmm.
about and do? Okay, I think that's it when it comes to preference shares. And then now let's go maybe to a bank loan. I think a bank loan is one of the simplest thing ever. You see, eh, which screen am I sharing over there? The one for the
You're sharing
question
the
paper.
question paper.
Okay, let me just stop sharing that one and then share this solution paper. You see, when it comes to bank loan, it's just simple. What you need to do, you just need to know this formula. Just simple like this. Cost of debt, which is like KD, is equal to interest. You open your bracket 1 minus tax, which in this case, our interest is that's 10.5. If you can check like your question paper, you can see like you've got like that interest of 10.5. And then 1 minus 30. So in this case, for you maybe to be in a very, very simple, okay, like in a good position maybe to solve this, you can change that percentage to a decimal so that you can be in a position maybe to subtract it from that one. You see?
Okay.
Yes. You see? Yeah.
And then just convert it back.
Remember
I
earlier
see.
on what I said. At some point in time, some student will, this is what they are going to do. They will change maybe this 30% to 0.3 and then forget to change this 10.5 to 0.105. So you shouldn't make that mistake just because it will make your answer wrong. So that's why in this case, like like when we're doing this, we change both the interest and the tax rate, and then work on this, multiply, and then you see like before before having like the final answer, we need like to match to convert this to percentage by
Yeah.
multiplying with 100. You are done with like stage number 2 of calculating like the weighted average cost of capital, and then this is like the final stage whereby now you are calculating like the weighted average cost of capital. Yes, the formula is just simple like this. I
Okay.
guess maybe during your examination, just because you will be writing it online, you need like to have all these formulas in place with proper examples.
Yeah.
And then like you need to also like what I'm saying to you, everything that I've shared with you, you need like maybe to write it somewhere where you will understand for easy reference during your examination.
Yeah.
Yes. Okay. Okay, at this stage, I think this is very, very simple. Don't be confused. Remember earlier on, we calculated like the cost, the weight of,
Yeah.
of those forms of capital. What you need to do, okay, so that maybe it can make sense to everyone. Let's see. Okay, this 6.977 is for ordinary shares. We take that weight over there, and then you need like to come here. 0.6 multiplied by 14% plus 0. This is for preference shares multiplied by
Yeah.
11%, and then 0.2 multiplied by 7.3%, and then you work out that you get like the final answer, which is like the weighted average cost of capital, and then you are done.
Yeah.
If you have done everything correctly, correct here, you are guaranteed 25 marks, which means
Hey,
now you are left
90
with,
serious.
yeah,
I'm getting a 90 serious.
yeah, you are left with like 25 marks to pass. You see, just because you must fight, maybe okay, if the paper is simple, you can go for 100%, but if the paper is difficult, fight for 50%. The unfortunate,
Oh, gig.
eh?
Okay, 50%.
Okay, I'm okay. No, 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 no. That's my advice to you. At some point in time, you find that this thing will be hell. At some point in time.
Yeah.
So, but I trust you. I trust you. I trust you.
Okay. Whilst we're just on this payback, whilst you're
This is
scrolling there.
not payback. It's weighted average cost of capital.
Yeah, sorry, we're done with that one, Nangit.
Yes.
Yeah, so you scrolled down, I just saw payback.
Payback.
Yeah.
Okay, there is AIR here and also payback.
Okay, yeah, no, I think, yeah, that's sorted as well. Yeah.
Okay, you are good when it comes to payback.
Yeah, yeah.
Yeah, even on this thing of like payback, okay. Yeah, at some point in time, you'll find that they won't give you what, like the cash flows. You need like to calculate them.
Ah.
Why are you laughing? No, they will give you like net profit, so you need like to calculate the cash flows.
Ah, that's a spanner move. Like I even
No,
got
no, no.
a nice.
That's another hint that I'm giving you. That at some point in time during your examination, they will not give you the cash flows. These cash flows, they will give you net profits. So you must do something.
Okay.
Yeah, okay, okay, okay. Uh, just give me a moment. I just want to remind myself with something here. Yeah, I want. Yeah, I've just remembered that. It's okay. Give me a moment. Give me a moment. And then one thing that maybe you need to do, you need like to visit our chat on our group. There is lot and lot of information there. We have okay.
Yeah, sorry, I was muted. I'm just seeing, I'm just checking
I'm
because
saying
I
you need like to
deleted.
visit our chat on the group that you created. There is lot and lot of information there.
But mostly some of the things, because I deleted the WhatsApp, some of the things no longer there, like the screenshots.
Why?
Hey, no, I had to delete WhatsApp.
What was happening, guys?
I win. Hey, I had to. So manja, I lost pretty much everything. Even some of the communication didn't download because backup Yami was up to a certain point. But I was okay with that up until now. Yeah.
So I'm trying to go to our chat. It's like I've forgotten quite a number of things.
You
Okay.
forgot.
Yeah, yeah. I'm from. Oh, we've been okay. I'm from the festive season, so come on. Yeah. Okay. Okay. Let's say maybe you are given like the what do you call this? Net profits instead of like cash flows. What you need to do you need like to add depreciation. You get me? The unfortunate part, I don't have like a perfect example. Maybe. Ooh, this medium. Sorry, this net does not exist in the internal storage. Ish. I deleted quite a number of things. Okay, I want to share with you just an example of what I'm talking about. I'll forward this on WhatsApp.
Okay.
Yeah. Please check your WhatsApp.
Oh, have you sent it already?
Yes.
Okay.
You haven't received it.
No, I got it. I got it.
Yes.
Oh.
So that's okay. That's how you go about maybe calculating the. If you've been like given net profit, you need like to add the depreciation. I hope you are following.
Yeah, so which is the net profit here?
Huh?
Because I said, okay, so you have here cost is 100,000, cost of capital at 12% depreciation at 25,000 a year. And then we have the first table, year one, 40,000.
Yes, okay. And then if you maybe you can go like wait, read as follows. Cash flow is equal to net profit plus depreciation. On year one, on
Yeah.
project what? It's project two, it's what? Yes, it's project 11, something like that. Year one, you will say like 40,000, which is like the net profit plus 25,000. Year two, 5,000 plus 25,000. So on and so forth.
Okay.
To get like the cash flows. If you have been like given net profits, not cash flows. Yeah. This applies when you are doing like your payback period, when you are doing like your net present value. What else? Yeah, I think the two.
Yeah.
Yes.
Okay, so how did we get from 40,000 to 5,000 to 5,000 to on year 2, 3, and 4?
You can see, okay, on that table over there, you see like cost of capital is 100,000, cost of capital 12%, depreciation 25. And then there is that table year one, year two, year three, year four. There is 40,000 of the project. The first project is 5,000. There is another 5,000 if I'm not yes on year three. And then there is negative. There is a loss of 15,000. That in accounting, when you put like any number, when any number is in brackets, which means like it's a negative number.
Okay.
It was a loss. So that's why in year four, I said like negative 15 plus 25.
Okay.
Yes. You're supposed to get like positive 30,000 as cash flow. So in the case whereby you wanna do what? Is it there? Yes, yes. Okay. In the case when maybe you want maybe to calculate like the average rate of return, which is like the AIR. It's the opposite. What if we are being given like the, what do you call this, the cash flows? You need like to convert those cash flows to net profit, which in that case you need like to subtract the depreciation.
Okay.
Yes. So in your modular guide, let me just I want you to pass this thing, and then have in mind that okay, this chapter 1 is always there during the examination.
Hey.
Chapter 1, the ratios.
Yeah.
Have in mind, you need like to study that big time. Okay, can you turn to page 60 in your modular guide?
Page 60. Okay, I am there.
Okay, where they are talking about AIR, accounting rate of return, average accounting rate of return. Okay, maybe page 58, 59, 60.
Okay, I think I've got it. I've got it. It's page 65.
65.
Yeah, I remember now. I have it on. I have a soft copy.
Oh, okay, yours is different from mine. Okay. I want us maybe to go through that so that you can have like a clear idea on what I'm talking about when it comes to this thing of like converting like cash flows to net profits. There is a perfect example there.
Okay.
Yes, there is a perfect example there. Are you there?
Yes, I'm here.
Yeah. Okay. There is that formula which is like AIR is equal to average annual profit over average investment times 100. So, and then it continues like average investment is what initial capital employed plus residual value over 2. And then I want us maybe to continue with like, so that you can like get an idea on what they are talking about there. And then if we can go to that example we over there, saying we can use the same data from previous example. Messi Motors just made investment of 420,000 in a state of a wheel alignment machine. Details are as follows. Okay, expected useful life is 6 years. Straight line depreciation. Hey, my sister, you need like to research about straight line depreciation, or I will share this information with you as soon as maybe. Okay, I get it. Just because it's another way of like it's a special way of like calculating maybe depreciation, and then there is also salvage value. There is cost of capital, tax rate. Okay, and then expected cash flow after tax are as follows. You see over there, you are given like cash flows.
Yeah.
These are not profits, net profits. So you need like to convert these. You need like to convert these to net profits. So if you can turn maybe to page 6, I don't know in your case, where they are now calculating like this AIR. So, and how do they go about maybe getting these net profits?
Okay, let me just see. I'm just trying to. No, I'm checking. Let's see where is that. Okay, so they have net profit. Okay. Oh no, they don't show. They don't show. Let's see how. They just have the net profit amount there.
The net profit amount, which means yours is different a bit.
Yeah, they just have the cash flow from 66,000 for year one and the net profit of 81,000.
Okay. Let me try to take a picture here. Let me try to take a picture.
Give me 2 seconds. I want to switch on the light.
Huh?
Can you give me 2 seconds? I just want to switch on the light.
Okay, let me take a picture of this.
Okay. Okay, I'm back. Okay.
We are born a
Yeah, so cash flow needs to be converted to net profits. This will
okay,
entail
like
adding.
is the solution they say, okay, like do you have like that table of cash flows year one, which is 66,000,
Yeah.
96,000. Okay, that's the
Yeah.
continuation of that table. And then when it says like required calculate the AIR, accounting rate of return, the solution cash flow need to be converted to net profits. This will entail adding back the depreciation tax shield. This is how you go about maybe doing that. We've got like the cost of capital or the cost of investment, which is like our investment, which is like 420,000. You need like to then deduct the salvage value, and then you get like the depreciable value, and then just because the useful life of this machine is like 6 years, you need then to calculate like the depreciation per annum. You need like to then that 300,000 divided by 6, and then you will get like the depreciation per annum. Yes, and then from there, that depreciation per annum, you need like to use that tax rate. You need to multiply that with that tax rate, which is like 30%. If you can check like the table, you get that 15%. That's 15% that you get over there is what we call like okay, that's the net profit, by the way, that you need like that you get per annum. And then on those cash flows, you need then to add no, it's not like net profit, by the way, it's a depreciation after tax. You get me?
What, that 15,000 is the
That
depreciation?
15,000 depreciation after tax. And then what you do on those cash flows to get like the net profit, you need like to add that 15,000.
Yeah.
it would be like 66,000 plus 15,000, you get 81,000.
You get
That's
881.
a net profit. 96,000
Yeah.
plus 15,000, you get 111,000. So on and so
Yeah.
forth. And then after
Okay.
it, after 6 years, you get like the total net profit. And then
Yeah.
when you want to get like the average net profit, you need like to divide that net profit by 6 and then get like the average net profit.
Yeah.
This is when like
Okay. That
when
was helpful.
huh?
You see, that was very helpful. I missed that part.
Yes,
We
and
have to
then from there
calculate.
you need to proceed and then calculate like the average investment, which in this case it
How
will
do
be
you
like
then?
eh?
Yeah, sorry, Ngiti, how? So I understand how you get the cash flow or the net profit now, for calculating the average rate of return. If we go back to trying to figure out figure out the cash flow, how do you, I'm not quite sure if I understand ukuthi uyenza kanjani that bit.
Ngiyiphi lo understand ukuthi yenza kanjani.
So cash flows, it's a net profit plus depreciation, right? Okay, so Lana, we get 40,000. Lana, is it something that we are given on the question? 40,000,
Which 40,000 are you talking about?
If we're going back to the screenshot, to Melele Sona. Yeah.
Okay, the first one.
Yeah, the first one, cost of capital. Yeah. So I just want to check now. For year one, we have the is that the project?
Okay, it's if I can put that thing, that table in a simpler way. Let's say let's say there are two projects there. There's project 1 and project 2. Yes. Project 1 and project 2. So in this case, yeah, just underneath there, I think like we're dealing with just project 1, which is that project 1 thing.
Okay, and that those figures there for project 1, those figures for year 1, 2, 3, and 4, you are given. You just need to.
Yes. You are given those
Okay.
figures.
Okay. All right.
You are given those figures are in net profit. So you want to get cash flows.
All right.
Yes.
Not
Okay, basically, maybe I can try maybe to differentiate to you cash flows and net profits. Okay. Okay, cash flow, if I can put it, it's any money that has come in and go out of the business, all the money. That's why like you at some that's why like we need like to add even depreciation, just because when you buy that particular when you bought that particular asset, for instance, we bought that machine, it may be 100,000, and then now it has after 4 years it has depreciated maybe to 50,000. But initially, the cash flow that was there is 100,000. We need like to include even the value that the machines that have lost. That's why like we need like to add the depreciation. While when it comes to this thing like of net profits, I'm sure maybe you are familiar with profit and loss. What do you what do they call this thing? This financial statement called like profit and loss. whereby like you need like maybe net profit. To get like net profit, you need like to put like your sales up there and then deduct all the expenses, and then you get like your net profit. Are you following? Hello? Yes. Let's take it. This lady is so blushing. Sebasha nge-load shedding eNemzansi. Kanti noma kashajisa ifoni yakhe. Ngisho asegcina akasatholakali. Kuma-South Africans sekamane kusichomela ukuthi kunjani. Sebangamane basichomele mani nami. Yabo kuyabanyisa lo kwe-technology.